This podcast is brought to you by Customplan Financial Advisors, Inc., an independent insurance managing general agency in Canada. Financialpodcast.ca was developed with one goal in mind: to educate Canadians on important topics that affect their financial well-being and make it readily available to all. We welcome you to plug in and learn with us. If you have questions, please email us at contact@financialpodcast.ca.
Hello and welcome to the Financial Podcast. My name is Gary Poyer. The Financial Podcast is brought to you by Customplan Financial Advisors, an award-winning managing general agency that provides exceptional support and resources to the independent financial advisor. Please visit customplanfinancial.com to see all of the resources that are available to you as the independent financial advisor. In today's podcast, we'll be taking a look at some of the more technical issues surrounding retirement income and retirement planning. And to help us understand these issues, we're pleased to have with us Lesley Bloxham, one of the partners from Lesley Bloxham LLP in Calgary. Welcome, Lesley.
Thank you very much, Gary, and I appreciate the invite.
Well, we're very happy to have you, and we're looking forward to the value and insight that you're going to provide. Lesley, please tell us a little bit about yourself, your background, and your firm.
Sure. So I'm Lesley Bloxham at Lesley Bloxham LLP, and I've had the great pleasure of working in accounting, taxes, and in the consulting field for close to 30 years. So I am a designated accountant in the US on a consultant basis only, as well as I'm a legacy CGA CPA in Canada. I really do love what I do and enjoy sharing my experiences with people and educating people. My favorite reward is just seeing clients able to obtain their dreams and their goals. Lesley Bloxham LLP himself has merged together in 2015. There's three partners in the firm. There's Randall Blesetti, Brian Broyles, as well as Lesley Bloxham. We decided to merge our sole practitioners firms together because it just made it easier for us to keep up with changing times, allowing us to be able to focus more on areas that we love to do, as well as to be able to assist a diversified set of clientele. Our firm is dedicated, and we'd like to consider ourselves professional as well as a personal service firm. The type of clientele that we do assist are people that own corporations, personal partnerships, international estates and trusts, in various different types of industries and revenue streams. So essentially, our motto is that we can assist you from before birth until after death. So like I say, our biggest reward is being able to see clients, financial planners, lawyers, whoever it might be, that they just meet their goals, their dreams, and their commitments that they have envisioned for themselves. So you're welcome to visit our website for a little bit more detail of how we assist other professionals, as well as with our clients.
Okay. And besides the three partners, how many employees work for the company?
5. So yes, and we're probably going to be seeking on and hiring another 1 or 2 people in the spring as well.
Okay, well that's good. So you're a growing company as well.
Correct.
Okay, excellent.
Yeah. So Gary, just before we continue, I just want to add a little bit of a disclaimer in there that this is for educational purposes only, and that they should be seeking professional advice either from a CPA or financial planner or lawyer. So any communication that does occur today is, like I say, just for educational purposes only, and that we can't be liable for any decisions people make based on our conversation today.
Right. Okay. Excellent. Well, I appreciate you saying that. So Lesley, when it does come to retirement planning, what do you believe are the primary goals or concerns that a financial advisor should be speaking to their clients about?
Well, to start off, I think when it comes to retirement planning, and it can even evolve into estate planning, tax planning, whatever that might be, the client should really seek what is called a power team. And that power team can have an accountant, a lawyer, and a financial advisor. In some cases, they'll have a business or a life coach involved too. And that power team should be able to collaborate in the best interest of your financial and non-financial goals. Unfortunately, I am not a financial advisor, so I can't provide guidance in particular from a finance perspective, but I definitely can give you a tax perspective.
Okay.
So I know ourselves with some of the questions that we ask the client is that, are your wills up to date? Do you have life insurance? Do you work with a lawyer or financial planner already? Going into retirement, are you looking at semi-retiring, continue to work part-time or only half the year? Are you looking at volunteering, or are you planning on just going full out, just retiring? And then we ask, okay, well, what does that retirement plan look like for you?
Mm-hmm.
What is your bucket list? What do you want to accomplish? What are your interests? Maybe you're changing your career. It can be big things, it can be little things. Maybe you have a puzzle or a book that you've been wanting to read, but you've never wanted to do it. Or maybe you're only going golfing once a month, but you want to start golfing 4 times a month instead. Mm-hmm. Might be cleaning out that storage shed, or it might be visiting family around the world. But as you know, all of this costs time and money. So other questions that we do ask is that where are you planning on living? Is there anything that you wish to buy during your retirement? You know, we have clients that are interested in buying a different type of home or a yacht, or start buying vintage sports cars. So we kind of need to know sort of what is that retirement plan looking for you. We look at what is your current inventory list of assets and debts. You know, how much do you need to live on? What is your actual financial state right now? How much funds have you already saved up? You know, what is that disconnect? Or have you utilized all 5 buckets to diversify your portfolio? And then we talk about, okay, how are we going to be laying your income? How are you planning on living? You know, is there any major health concerns? And most importantly is, do you want to leave a legacy for your children or extended family or to a charity? Because as you know, when you're doing retirement planning, we do have to ensure that the financial planner, as well as on the tax side, that we're meeting your financial growth and wealth needs. Mm-hmm. So in short, we need to make sure that you have enough funds for retirement.
All right. Okay, so it sounds like you take a fairly or a very comprehensive approach when it comes to retirement planning.
Correct.
Okay, excellent. In Canada pension plan is obviously a big part of a person's retirement, and as most of our audience knows, because they're financial advisors, the normal age to collect CPP is age 65 rather. But it is possible to collect at age 60 or defer it to age 70. Is there, or what are your thoughts about when it's appropriate to collect it early, and when is it appropriate to collect it or defer it until, say, age 70?
Well, actually, Gary, that is a very challenging question to answer. And the reason being is everybody has their own financial goals and unique tax situations. Okay. But as a rule of thumb, when we're asking the questions like we stated above, before even advising clients and the best tax situation for them, we take a look at what is the health and the age of the individual. If the person has a terminal illness or health issues that we have to be concerned about, or maybe they couldn't find work and they're dipping into their savings right away, or maybe they just don't want to work and they do want to retire early, then that might be when you want to collect early. The disadvantage of course, if you do collect early, there is a penalty to it. So you do have to live longer in order to be able to meet that break-even point. Mm-hmm. But other considerations that we do take into, when is a really good time to collect CPP is, are you still working, or do you own your own business? Have you maximized your CPP throughout your working life? What is your current taxable income? What is your current marginal tax rate? are you currently meeting your financial goals? And then we also have to consider the timing of your spouse as well. Have they even maxed out their CPP contributions? So generally speaking, with our experience at the firm is that we are seeing people that are living longer and they are working longer and they're still fairly healthy. So they are delaying taking their CPP benefits to optimize their tax situation, and they're able to collect higher payments because they waited longer.
Right. Okay. So there isn't a cookie cutter approach. Like that, a lot goes into that decision.
Mm-hmm.
Right, and everybody's different. So just because your neighbor maybe started CPP early or deferred it doesn't mean you should either.
Correct.
Okay. All right. That makes a lot of sense. Okay. So Lesley, when it comes to accumulating funds for retirement, how successful do you believe Canadians have been when it comes to using registered plans like the RRSP or the tax-free savings account?
So I feel that with the people, as you know, there's some people that don't believe in RSPs, and then there's some people that don't believe in the TFSAs. And that might be because they've had bad experiences or they've heard of bad experiences from other people. But overall, our firm experience with the clientele that we've worked with, or even working with other financial planners, so on and so forth, is that we are seeing people actually utilizing both programs as part of their retirement plan, both short-term and long-term. So with the TFSAs, they're utilized in our experience of what we've seen more on a short-term basis and on a rainy day basis, or if they just need those little extra funds, whereas the RSPs is utilized more for the long-term locked-in plan. So they know that is a guaranteed income per month. Mm-hmm. So from a tax perspective, RSPs are great for mid to higher income earners to decrease their taxable income and marginal tax rates. But TFSAs is mostly utilized when the RSP contribution limits have been fully exhausted. And we usually see this in people who have company pensions and over the age of 45. So then they start working towards on their TFSAs and growing their money in a tax-free environment. The TFSAs is also a great savings tool for seniors and lower income earners to conservatively invest their money without having a huge tax consequences or affecting their social benefits. So yeah, we are seeing both programs being used. It just, again, it all depends on the person and the financial planner in your power group that works with you in your unique tax situation.
Okay. So Lesley, for a Canadian who is retired, there are a number of non-refundable tax credits available. Can you explain how the pension credit works, what sources of income it involves, and how it can be used most effectively when dealing with spouses?
Yeah, so I think we need to back up a little bit on that question and let's answer what is a non-refundable tax credit. So just to brief you on what a non-refundable tax credit is that they are credits that the government allows you to reduce your federal tax calculation. Okay. So if your non-refundable tax credits are greater than the federal tax calculation from taxable income, then there won't be any federal taxes owing, nor will you receive a refund on the difference in between the federal taxes and your non-refundable tax credits. So, and also too, is that we're only going to be speaking about today about the federal portion and not the provincial portion, just because each province and territory, wherever you may live in, will have different rates of what the non-refundables look like. Okay. So going back to your pension credit, so the most qualifying factors of a pension credit is that you're greater than 65 years old, you're receiving an eligible annuity payment, pension income, RSPs, or a RIF withdrawal. There are several qualifying factors and rules that we do need to take into play. For example, if you're less than 65 and your spouse just passed away, are you able to have the pension credit because you've now obtained the RIF? So it is of course, best to talk to your tax advisor a little bit more about the pension credit. But in short, if you are eligible for the pension credit or the pension splitting of the credit with the spouse, is that if the spouse is of an eligible age, and the spouse doesn't already have a pension income, then you as well as the spouse can both have $2,000 each as a non-refundable, and which in turn is approximately $300 deduction from the federal tax calculation.
Okay. And has that $2,000 limit, has it gone up at all, or is it?
No, it's not an index. No, it's not.
Oh, that's too bad. So any idea how long it's been 2000?
Unfortunately, I do not know that.
Well,
sorry.
But quite a while, right? It's
correct.
That's too bad. What about the age credit? How does the age credit work?
So with the age credit, in short, the most common qualifying factors is that you are greater than 65 as of December 31st of that taxation year, okay, and you are low income. So if we just give an example for the 2022 taxation year coming up, if your income level is less than $39,826, then you're eligible for a maximum age credit of $7,898, which means $1,184 can be deducted from your federal tax calculation. The age credit can be transferred over to a spouse if it is eligible, but do keep in mind there is a formula involved, and that the income is indexed every year, as well as the age credit can increase or decrease from year to year. And CRA does provide a worksheet to do that calculation. So if your income does become greater than $90,313, you don't qualify at all for the age credit at all.
Okay, well, that income is fairly high, like $90,000. That's I think I'm not sure what the average income is in Canada, but it's probably less than 90,000.
Yes,
I would guess so. Okay, but what about the medical expense tax credit? How does that work? Because that seems to be kind of confusing for some people.
Yes, so the best advice that we generally provide our clients is to review the CRA website in regards to your eligible credits, medical credits that are available. And it's easy as searching eligible medical expenses. This is a 14-page document, and it does change at least twice a year. So we do invite people to review the website often just to make sure. One thing that we really noticed in the last year is that CRA did expand the qualifying factors, so you don't need a prescription for everything anymore. Okay. So that's why we do invite people to visit their website. So the medical credit itself is consider it as when you add up all your medical expenses, and we do apply it towards a formula, and what we call within that formula is what is called a deductible. So you can look at it like car insurance is that you have to pay a deductible first, and then anything over and above that, you get a credit. Okay. So the deductible determination is based on what your net income is times 3%. Now, that deductible is capped at $2,479 for the 2022 year. So that means that if you have reached the cap amount, your income is greater than $82,633. So once we've calculated what your total medical expenses less your deductible, then you get the remaining tax credit. And then that tax credit, the residual amount then becomes part of the calculation of the eligible amount of the non-refundable that we can reduce what your federal tax amount is.
Okay. Is there, can you combine more than 1 year for the medical tax credit?
No, it has to stay within a 12-month period, unless if, of course, the year of date of death, then you can go back to 24 months. But no, it's only within a 12-month period. Generally, people are on a calendar year, but say, for example, 1 year you didn't claim medical expenses, and then the next year you had major knee surgery and you had to travel to Victoria. Then you might do your year-end date to be in November, just to be able to maximize the amount of medical expenses that you can have in that 12-month period. You can adjust it from year to year, but you do have to make sure that there is no overlap or double dipping of the medical expenses. And the medical expenses can be combined on one return. So that means with your spouse, with your dependent minor children, as well as if you have other dependents, such as parents that maybe have disabilities or low income, or they are dependent upon you. So there's also other several qualifying factors for the medical expense tax credit. So we always invite people to talk to their tax practitioner a little bit further about what expenses might be eligible and which dependents are eligible for you to be able to claim on their behalf.
Okay. Yeah, Lesley, just listening to you talk about the non-refundable tax credits and the detail. How did you get interested in being an accountant?
How did I get interested in being an accountant? Because I wanted to be able to help and assist people to be able to maximize their tax situation and keep more money in their pocket. Okay.
And obviously you like numbers, because you've rattled off a lot of different numbers and 3% of this and the cap and stuff like that. So I'm glad there's people like you around to help people with their tax situation, because not everybody likes math, and you obviously do. What about the disability tax credit? How does that come into play, and how is it in relation to the medical tax credit? Like, how do they work together?
How do they work together?
Yeah.
Well, there is several qualifying factors when it does become for the disability tax credit. But essentially, in order to be able to get the disability tax credit, the CRA does need to make a determination. And generally, we do let clients know to go after get approval by the CRA for the disability tax credit. Because once you do that, it does help you to get into more social benefits and social programs within your province and as well as with your city. So getting that determination at a federal level helps with the push down to other areas as well. So you would talk to you could talk to your accountant, or you could talk to your eligible professional medical practitioner first, and your your professional medical practitioner would complete an electronic application online and submit it to CRA. When CRA is reviewed and as well as approved and state that you are eligible for the disability tax credit, it is important to let your tax advisor know in case if there's any corrections or adjustments that need to be made. The disability tax credit can be applied to 10 years back with tax returns. So we do have some people that even just through conversations that we have with them with new clients, and I had this medical condition and I've had it for a while. Okay, well, let's go after the disability tax credit. And we have seen people receive refunds from up to 10 years back with the disability tax credit. So in 2022, just on the federal, this is not provincial because each province does have a different disability tax credit amount. The eligible tax credit for 2022 is $8,870. And this credit can be used to reduce the federal tax calculation, which does result in a reduction of $1,330. The disability tax credit can be transferred to another individual as long as if there is qualifying criteria, and also too is that they are eligible dependent on the higher income earner. and then I know that your next question is probably, okay, well, how does long-term care facilities take into play when it comes to disability tax credit?
Right.
It is important to speak to your medical profession, your tax professional about it, because there are different qualifying factors, but in short is that we do look at what is the health of the person, their dependency, and their mental capacity, because the long-term care facility medical claim that you can make on your tax return is dependent on those three factors. So, for example, if you are in a dementia ward, then you're lacking the mental capacity. You are fully dependent, and you may have degrading health. So, your long-term care facility credit may be higher than somebody who has made a pro-choice to go into a long-term care, but does have still their own dependency. They have mental capacity and they have good health. Okay, so when we do look at long-term care facilities and the disability tax credit, there's three choices that you can have. You can either claim just the disability tax credit, or you can just claim the long-term care expense, or a combination thereof. And that's where your tax practitioner will definitely guide you on which is the best bang for your buck, the best deduction for you, by taking a look at those three ways that we can calculate the combination thereof for your medical expenses.
Okay. You talked a lot about the non-refundable tax credits. Is there, like for every federal non-refundable tax credit, is there a matching provincial one, or are there some federal non-refundable tax credits that aren't provincial?
It's based on a province by province basis. So, but generally speaking, and I can't speak for all provinces because I do not work with clients in all provinces, but when I look at clients that we have in BC or in Nunavut, in Saskatchewan, Manitoba, Ontario, as well as in PI, Newfoundland and Nova Scotia. So yeah, you'll notice I didn't mention Quebec. Is that we can, there are some matching, but matching in a sense that you will have long-term care facilities and you will have the disability tax credit, but they're not the same province to province. So like, for example, in Alberta, it might be just over 13,000. We haven't seen the Royal Assent amount yet for Alberta, what the credit is going to be for 2022, unless if it just got posted this morning. But in Alberta it's 13,000 and BC might be 15,000, if that makes sense.
Yeah. Okay. All right. Well, leaving the tax credits for now, I want to ask you, Lesley, most financial advisors are familiar with defined benefit pension plans and defined contribution pension plans. But what about individual pension plans? How prevalent are IPPs? Who do you believe they're suitable for? And what are the circumstances where they would be appropriate?
Just to explain a little bit what IPPs are, is it's an individual pension plan. They're generally used for business owners or family-owned businesses who are CCPC corporations, so private corporations. We do work with clients that have IPPs in their within their corporations. And when IPPs are generally used, and like I said, I'm using generally as a loose term because it is dependent on the tax situation between the corporate as well as personally for those individuals, is that generally speaking, it's when the business owner has exhausted their personal RRSPs and they want to start a pension plan up in the corporation. Also, too, IPPs is a good retirement strategy for business owners, regardless of whether or not they've exhausted their RRSPs, for just the sake of creditors' protection. Also, too, is IPPs is good for corporations that have excess cash and is a way of purifying to make sure that we only have active assets in the corporation. So Since CRA has updated the rules with the IPPs, it does make it a little easier for small to mid-sized businesses to start IPPs. So we have been seeing more IPPs, corporations being starting up in corporations compared to even just a few years ago. So not to go into too much detail, but just to summarize, with the IPP, it does form a pension. We do calculate on a formula basis years of service, what the employment income management is, plus a lot of other factors. The company makes payments into this pension plan, and they do become a deductible expense in the corporation. The IPP should be managed by a financial advisor, as well as an IPP specialist that is approved by CRA.
Right.
Also, too, is that once you've started the IPP, we do need to make sure it vests there for at least 3 years before you even close it down. And then upon retirement, if you're winding up your corporation, we can pull it over to a LIRA account. So, do keep in mind there are many other factors. I'm just giving you a Coles Notes version of what an IPP is, and it's advisable to talk to your financial planner or your tax advisor if the IPP is going to be a good fit for you.
Okay, excellent. What about our retirement compensation arrangement? Are they similar to an IPP, or how do they work?
Where we've seen RCAs, or retirement compensation arrangements, is generally is more of a tax deferral pension program, and is more for higher income earners. For example, like executives, athletes, large businesses, large corporation, expats, intergenerational companies, and incorporated professionals. So it is a little bit of a different avenue compared to IPP. RCAs can be deductible in the corporation if contributions are made by the corporations into the RCA. For the key employees, the benefits for the RCAs, they are credit proof, they are a flexible plan, they are exempt from payroll taxes, and taxation only occurs upon the withdrawal of the recipient. So, do keep in mind there are a lot of other qualifying factors for RCAs, and we do advise you to speak to your tax advisor or financial advisor a little bit more about it.
Right. Okay, just so that I understand. So IPPs are for Canadian-controlled private corporations, but RCAs can be for both private and public corporation?
Correct.
Okay. All right. Perfect. Okay. What about universal life policy? I've heard universal life policies can be used for retirement planning as well. What can you tell me in that regard from a tax perspective?
So with the universal life insurance policy, it's normally set up in a corporation so that the corporation does have a policy on key management or key business owners, so that in a case if they do pass away, it doesn't incapacitate the corporation itself. The corporation is still able to run. And what I mean by that is that the corporation is still having enough funds to pay off any debts, so on and so forth. We do see people use the universal life insurance policy, whether it's corporate or personally, as another retirement avenue, just because you're able to overfund the universal life insurance policy over and above its premiums, and then it can grow in the policy itself on a tax-free basis. Now, if you have the policy in a corporation and depending on the type of policy, because even though it's a universal life policy, we have been noticing that the new type of policies that are coming out, it does allow you, if you've lived long enough, that you can actually draw out on the policy upon once you've reached a certain age, and you can also borrow against the policy too. Right. So, upon of when you say pass away or you become incapacitated, and the policy is in the corporation, then an effective tax strategy might be is that you'll have the policy come to fruition, then you start withdrawing on it through a CDA, a capital dividend account. Now, keep in mind, there's a lot of red tape and compliance around this, and it can be an effective strategy, but you should really speak to your tax advisor or financial advisor about, is this the right fit for me? Okay. Now, when you look at it on a more of a personal level, so say, for example, you are a higher income earner, is this type of policy good for me? It can be if you have excess cash. And people generally will use this type of policy as part of their estate planning as well. So then therefore, it's an insurance policy that they're going to be able to pay off any tax or any debt upon death. If you have the policy be the beneficiary of the estate or a specific person. So it is a good way, like I stated, to put excess cash, grow it tax-free in the meantime, but upon when you actually mature the policy itself, there might be a taxable amount involved, for example, interest earned and so on and so forth, that you would still get taxed at the end of the day.
Okay. Just out of curiosity, does your firm have somebody that sells life insurance as an employee or part of the company?
No, we don't.
No,
we work with financial advisors that look at life insurance policies for our small business people or people that are higher income earners.
Okay. So just as a final question, Lesley, when you have a business owner or a professional who's financially able to retire, but who just doesn't know what they want to do in their retirement, they have no idea what their retirement looks like. How do you help this client gain clarity and direction?
Well, that's a really good question, Gary. And that's where our personal service comes in for our clients, is because we start asking them questions about both financial as well as non-financial reasons of possibly retiring. We look for keywords in the conversations that might pique their interest. So, for example, if they already own a business, but they're having a hard time relinquishing control of that business, then we might suggest why don't you just keep an office there and you still go there and participate and you have coffee, so on and so forth, and then slowly letting go of control. We look at, okay, well, maybe we create a hobby business for you. Is there something that excites them? So succession planning can be very challenging, especially in family-owned businesses. And there is a special designation that you can get that does work with a succession planning for family-owned businesses. But we suggest with any financial advisors, as well as accountants and lawyers, is to start talking to them 10 years earlier about at least what does retirement for you? What piques your interest? What do you want to do? And that goes back to when we first talked of, the questions that we were asking when we visit clients, when do you want to retire? How long do you plan on living? Those type of questions that's what helps us determine of what does retirement look like for you. And it is hard and it does change because, there are some people that do want to travel the world and there are some people that are just very happy in their home space. So, and I always advise clients, start small. Start something like maybe you just want to be able to do a puzzle in a weekend and not have to worry about you're rushing off to go do something else.
Right. Yeah. Do you find in your experience that if a business owner or professional retire and then say sell their business or their practice, that they kind of go through a bit of an identity crisis? Like they were a lawyer for 40 years and then they retire and they're no longer a lawyer. So they kind of wonder who they actually are. Do you find that happens at all?
I haven't experienced that personally with any of the clients because generally speaking, people that have been doing their profession a long time, like there is a joke out there that accountants don't die. And the reason is that you do see an accountant, even after that they've sold their practice, they're still dabbling, whether they're taking professional development. Like myself, I take over 100 hours of professional development a year just to make sure that I'm able to provide the professional service to my clients. And part of that is that while you're taking professional development, or we find that they take on volunteer positions in the area that they used to work at, or they will become consultants and so on and so forth. So for people to cut off cold turkey, unfortunately, the ones that I have seen done that, they passed away shortly thereafter. So,
Yeah.
So therefore, we always advise them to stay somewhat active at some level before just going cold turkey.
Yeah. It's kind of funny because you need a reason to get out of bed, right? And you need some purpose in your life. And, people that quit cold turkey and do something completely different sometimes start to drift and lose their enthusiasm for life, I guess, and pass away. But Lesley, you know what? It looks like we're just about out of time. I want to thank you for talking to us about some of the technical issues surrounding retirement income and retirement planning. You've provided tons of insight and value, so thank you very much. It's much appreciated. Lesley, how can our audience get in touch with you?
The best way to get in touch with us is that you can visit our website, which is www.bbbcpa.ca. Or you can just Google search Lesley Bloxham. I do come up that way as well. Our office phone number is 403-277-0511. If you have any questions, you can email us at info@bbbcpa.ca.
Okay, excellent. Well, thank you for that information. And I want to thank one more time our sponsor, Customplan Financial Advisors. Customplan Financial Advisors is an award-winning MGA providing exceptional support and resources to the independent financial advisor. Please visit their website at customplanfinancial.com. This podcast is available on YouTube, Spotify, and at financialpodcast.ca. To be notified directly when new podcasts are available, please subscribe by visiting financialpodcast.ca. If you have an idea or a topic for a podcast, or if you know of someone who'd make a great guest, please email me at info@financialpodcast.ca. We'd also love to receive your feedback. Thank you again, Lesley, for being our guest, and to everyone else, have a fabulous day.
The views expressed here are those of the participants and not those of Customplan Financial Advisors, Inc., its affiliates, or subsidiaries. This is not intended to serve as a complete analysis of every material fact regarding any company, industry, or security. This presentation may contain forward-looking statements. Investors are cautioned not to place undue reliance on such statements, as actual results could vary. This site and podcasts are for general information purposes only and does not constitute investment advice and is not intended as an endorsement of any specific investment product or service. Individual investors should consult with an investment professional about their personal situation. Past performance is not indicative of future results. If you are unsure about what is the best course of action for you in your financial planning, then we suggest you consult a fee-based independent financial advisor or get in touch with us to discuss your individual situation. Our phone number is 604-687-7773.